Yeah, exactly. Thank you very much. Absolutely. I'm very proud of this as well. Me too. Good morning, everybody, and welcome to this Bruegel event on climate finance. It's great to see you all in the room. We have lots more people joining us also online, so we have a good audience. And we have an all-female lineup here to discuss how to unlock the trillions. And we'll, I think, have a quite lively debate. When you're in the room, you'll be, after we've had an initial discussion, invited to ask questions, so you can start getting your questions ready. And for those of you online, you can also ask questions via Slido. So the hashtag is climate finance. Put your questions in there, and I will come to them a little bit later after we've had the initial presentations. So I'm very pleased to invite welcome Alissa Kleinayenhuis, who's the author of a recent Bruegel policy brief, along with our director Jeremy Zettelmeier and Professor Patrick Bolton, on the economic case for scaling up climate finance, looking particularly at supporting decarbonisation in emerging markets and developing economies. That publication goes into some detail on why it would make sense for everybody in the world, but particularly advanced economies, to finance decarbonisation, particularly coal phase out. So Alissa will do an initial opening presentation to explain the main points in the paper, and then we'll have a short discussion between our distinguished panelists. So we have online Yasmin Mozinia from the Sequoia Climate Foundation. We can see you online. Yasmin, thank you very much for joining us. She wasn't able to travel to Brussels today, but it's really super she can join us online. And Yasmin, of course, has a distinguished career in the UK government, where she had various roles, particularly in the Treasury, the Finance Ministry, working on climate finance. So she's able to bring both a governmental as well as foundation perspective, and both a British and an American perspective to our debate, and she particularly worked on COP26. We have also in the room Alessandra Scobbi, who's the head of unit for climate finance at the Commission in DG Klima, so she'll be able to give us that perspective. And we have Turaya Triki, the director of international partners at the EIB, the European Investment Bank, in the Global Directorate. So we have quite a range of perspectives this morning. I'd like to start, Alissa, with your presentation of the issues. We have only 6 years, perhaps a bit less, of carbon budget left. And are we spending our money wisely? How could we be unlocking a great deal more? Over to you.
Thank you so much. Let me see if I can pull up my slides. So thank you so much, everyone, for being here. It's a great pleasure to be here at Bruegel with an all-female panel. I'm also very pleased with that. Today I will be talking about the paper that Heather just introduced on the economic case for climate finance at scale. And indeed, in response to Heather's remark, we are today at the same time, time where we are making rapid progress in rolling out renewables. But if we look at the most objective measure of how we're doing on tackling climate change, we see that global emissions are still rising today. And that any reduction in emissions is more than of richer countries such as or regions such as the EU and the US are more than offset by growing emissions in emerging and developing market economies. So what you see on the slide here is that, for example, the emissions of both India and China are rising rapidly. And so if we are to bring about global net zero, which is what we need to bring a halt to the driver of climate change, it's not going to happen unless we bring emerging and developing market economies on board at scale. So what we're talking about in this policy brief is how we can bring about decarbonization in EMDEs. And in this paper, we specifically focus on coal. So what I'm showing you here is a cost-benefit analysis, which we've done based on assets globally at as granular as the plant and the mining level, to assess, how much does it actually cost to phase out coal, and how much would it cost to replace that with renewables, not only to meet what is being phased out, but also to keep up with any growth in energy demand that is projected in many regions of the world, such as Africa. And also not just to build the renewables, but also the complementary batteries, short-term storage via lithium batteries, for example, and long-term storage via electrolyzers. So essentially what you can ask for every country, and this is what we are here presenting at the global level, is, right, what's the current country's energy mix? In this case, how much coal does it have? What would its phase-out pathway need to be net zero by 2050 and aligned with the remaining carbon budget of around 200 gigatons? And given the phase-out schedule, and given the projected energy demand under business as usual, how much renewables would you need to build? So what we document here is that the net benefit from phasing out coal is very large. This is shown in the lowest, one of my sticker works, in the lowest set of bars, showing that the net gain is around over the 2024-2050 period, at least 78 trillion dollars, and over 63 if you subtract the investments in complementary batteries, and even over a shorter time horizon, like up to 2030, the net benefits globally here I'm talking about are very large. And we've done a rigorous comparison against other estimates, such as those by the International Energy Agency and the IFC in their latest blended finance for EMDE reports. And what we find is that the estimates are quite comparable. I think what we've done possibly at least more transparently and better is that we didn't just get regional estimates. We have country level estimates and even more detailed estimates at the plant level. And importantly, what we argue in this work is that there is an economic case globally to not just pay for the build out of renewables and help catalyze investments in those, but actually there's an economic case to pay polluters to stop polluting and essentially compensate for the opportunity cost of coal, and that sound economic logic under the Cohesion line of reasoning, where you say, paying the polluter is sound economic logic if it makes you better off. So a lot of the global conversation on the transition is focused on renewable rollouts, whereas a critical point that we're making in our paper is that the climate crisis is a fossil fuel crisis, and if we want to halt that crisis, we need to pay for early closure, because to stay within the carbon budget, that is absolutely necessary. And that is not going to happen from a political economy perspective unless you make it also just. And we argue compensate for workers that need to be retrained, workers that might temporarily lose their job. And also we argue, and this by some might be seen as controversial, but we think it is a bargain, pay basically for coal, pay for the stranded asset value of coal, because it's literally globally 331 billion, whereas the damages by coal are in the trillions. So it's an economic bargain to pay for that. And even though the stranded asset value of coal is positive, the social stranded asset value of coal is extremely negative. So now the next question is, okay, how can we move from the analysis at the global level to the analysis at the country and the regional level? And so what are the country level costs and benefits? So what you can do is you can actually estimate the country level social cost of carbon, which is a share of the global social cost of carbon. So if you, for example, have $190 per ton of CO2 global social cost of carbon, which is the number that the Biden administration currently maintains, then you can ask, okay, what part of that is the benefit that an individual country would get, or conversely the harm, from 1 extra ton of CO2, which is a fraction of that total. So the sum of the country level social cost of carbon adds up to the global social cost of carbon. So what we then do in the next slide is we ask, okay, so what are the costs of phasing out coal in each country, assuming for now that each country would fully pay for itself. So the top row we show the case where 100% of the costs are paid for in terms of the investment cost by that country. And in the bottom plots we show the case where the country is able to mobilize private finance, so it only pays 25% of the investment cost in renewables and can generate 75% of the remainder from capital markets. And in both cases we say that it is the public sector that would need to compensate for the opportunity cost of coal, so it has to pay 100%. So what we show is that in many cases, at least if you don't include air pollution benefits and if you have a relatively conservative estimate of the social cost of carbon, actually the net gain is negative. And there are a few exceptions like the US, and that of course in part has to do with how, which we take from a Nature paper, the country level social cost of carbon is estimated, which is also based on current wealth. Right, so if you have wealthier, you have more to lose, which is possibly not a completely fair way to estimate the social cost of carbon. But anyway, so what we then do next is ask, okay, so is under the Paris Agreement, there is an understanding that wealthier developed countries should take the lead to help bring about global decarbonization. And the way that it's currently mostly argued is essentially an obligation under Article 9. Given the advanced countries, developed countries, greater historical wealth and also greater historical emissions. But what we say in this paper is providing the provision of climate finance by developed countries to emerging and developing market economies is not just equitable, it's not just an obligation, it also is, but actually it's in the economic interest of developed countries to provide climate finance at scale to emerging and developing market economies that consists of compensation grants to pay for early coal closure and in part of the investment cost in renewables to be able to crowd in private finance from international capital markets. And so what we show in these plots is that if you, for example, can use 25% public investment costs to crowd in the remaining 3/3 from private capital markets, that the net gain to advanced countries is very substantial, even over short horizons. So for example, if we look at the bottom left plot, we see that the net gain to advanced countries of paying for the complete decarbonization away from coal in emerging economies is 131% when you compute it as its benefits minus its cost over its cost. And for the advanced country provision of climate finance to developing countries, we find that the net gain in relative percentage terms is 200%. So what's the intuition here? The intuition is essentially that the amount of climate finance that advanced countries would have to provide is a lot smaller than the avoided climate damages that they would otherwise suffer if they would not make this bit of investment to crowd in private capital and to pay for early closure. Because if they essentially, right, let's take an extreme example, where developed countries manage to decarbonize tomorrow completely, developed countries would still be headed for climate disaster if they cannot bring EMDEs on board. So the benefits to advanced countries from the provision of climate finance to EMDEs essentially consist of its avoided climate adaptation costs, its avoided climate damages, and those are very substantial, as you are witnessing already today, for example, most recently with Hurricane Helene and the latest Hurricane Milton in the US. These damages easily run up to billions. And what we're saying is, if you pay a little of climate finance, the avoided damages are greater. And moreover, you can actually help support a global economy that is stable, where you may not get huge migration flows because certain economies might become virtually uninhabitable. So as Janet Yellen said this summer in July 27, she said, filling the climate finance gap is the biggest economic opportunity of the 21st century. And it's really, I think, the difference between, going towards a hothouse world with global instability and a lot of economic destruction, and actually supporting a globally thriving economy that is inclusive of all countries. So I guess where I will now almost conclude my remarks is saying that we have had the goal of 100 billion a year offered from developed to emerging and developing market economies, but there's wide recognition that that is a political number, not reflecting the needs of EMDE economies. So there's a very important COP coming up, COP29, where a new quantified goal of climate finance is set to be agreed. And the discussions essentially, and I'm going to skip forward 2 slides, are, what does the quantum need to be in terms of the goal, right? How much public funds should be provided by developed to emerging and developing market economies? What should be the quantum in terms of the global climate finance goals, which might be a bigger goal than just what the public sector would provide. It might include the goal set for total global climate financing flows towards EMDE decarbonization or even global decarbonization. And what's the time frame over which these climate finance commitments need to be delivered? What is the thematic scope? Does it only revolve around mitigation, or also adaptation, or even biodiversity, or damage and loss? And who are the sources that are contributing, and are there other qualitative elements that should be considered? So, such as policy, supportive policy, and reform of MBDs, and so on and so forth. So let me show you this slide and then come back to the backup table that gives them more details. Based on our study, this is the last slide anyway. So based on our study of what it takes to phase out coal globally, we estimate that the climate mitigation finance needed for emerging and developing market economies annually to just get rid of coal is 190 billion. And the cumulative amount over 2024-2030 is 1.3 trillion. And up till 2050, that cumulative amount is 2.6 trillion. So if we are working with a negotiation that focuses on an inner quantum of public climate finance pledges, this is what we would need at a minimum for a subsection of climate mitigation finance, which is coal. And so if we then look at what is needed to phase out coal globally, assuming that only 25% of investment costs in renewables are covered by the public sector, then the total climate finance mitigation goal, including also private finance flows, would need to be annually around 760 billion US dollars. Reaching up till 5.3 in 2030 cumulatively, and 10 trillion up till 2050 annually. And what we recommend is that it's very important not just to consider grants for adaptation, as is currently discussed, but also grants for early fossil fuel closure. And not just concessional loans for the build-out of renewables, but grants / at-risk investments or equity investments to help crowd in private capital for renewables. So let me conclude here. Very much looking forward to hearing your questions and the discussion.
Thank you very much, Alyssa. We'll be able to go into some more detail also on the study in the discussion. I'd like to get some reactions now from our distinguished panelists, starting with you, Yasmin. Yasmin Mouzinia, as I mentioned earlier, has worked particularly on COP26 when she was in the UK Treasury, and also you've seen a lot of projects on climate finance with your responsibilities for funding from Sequoia in this area. How realistic do you find this in terms of political economy, Yasmin? Alyssa has presented the economic logic of paying off polluters, and even presented the unusual view, the rather daring view that not only coal miners should be compensated, but also the owners of coal plants should simply be paid off with grants or equity. And she's also argued that concessional loans for renewables build out is just not enough. Would that actually work for getting earlier closure of coal?
Thanks, Heather. Thank you so much for having me join this discussion and for accommodating me to join virtually, although I'm not too far away in London. Alyssa, thank you so much for this paper that you worked on with Patrick and Jeroen. It's fantastic to have really well thought out analysis and some really practical suggestions for how to apply that in this space. So what I wanted to do was just point to a couple of the key lessons, I think, that this paper sets out, or key messages rather, and then some of the lessons that I've learned, because none of this is really theoretical anymore. We've had several years of practice in this space. So I think some of the key messages from a policymaker perspective, having sat at the other side of the table, are understanding the costs. Right? If you're sitting in any finance ministry in a G7 country or G7 plus country over the last 5 years, you're facing some really difficult choices around the fiscal envelope that does or doesn't exist. We're obviously seeing lots of economic policy responses to that now as governments have come in with new mandates post-elections over the last 12 months. But having a sense really of the scale of the finance is so important. I find particularly since more reports have come out, like the Draghi report on competitiveness in the EU that talks about a sort of 4 to 5% of GDP investment in the economy, a helpful kind of benchmark for your roughly 0.5% of the cost of this early fossil phase out, Alyssa, and hopefully we'll have more sense of scale like this coming out to give a better sense of the choices. Your argument that there's no point in an advanced country pursuing decarbonization at home without bringing the EMDs along with us is key. And it's one of the arguments that I think there's very little political space for, given this lack of fiscal space in economic policymaking recently in the G7 plus countries. And so I think whatever we can do to continue to hone in on that message and bring it really to life is one of the most important things that we can do. And then your really kind of nuanced breakdown of the stranded social costs versus the hard economic and financial ones of shifting the energy infrastructure is a really important one, and one that I've especially seen from the philanthropic side since joining Sequoia Climate Foundation a couple of years ago. So having kind of called out what I think some of the most important messages are from your paper, for a policymaker at least, I wanted to share some reflections on the sort of lessons learned from the various JETPs that have already been attempted by the G7 plus countries, many of which tried to follow a sense of the logic of the suggestions that you set out in the paper, and also from the perspective of being a philanthropic donor, where we've been asked to sort of help on several occasions with some of those social costs that you call out. So let me just share some of those reflections. From the donor side, making the case on scale and the amount and the type of financing is certainly the first kind of obstacle. Making the case in a transparent democracy where each penny of taxpayer finance needs to be justified and is scrutinized, especially during a period which the initial, early years see cost go up massively, generally tends to be the lifeline of a democratic administration or government, is just challenging given the context that I explained to you before. And so what we've seen has been sort of donor countries coming together to try to share the costs. And then in particular, trying to mobilize the private finance into this space behind that kind of early donor capital. I think one of the lessons that we should learn on the government side is that your 25 to 50% of the cost is nowhere near where the governments are right now in terms of their offer for the existing JETPs. Those in Indonesia, Vietnam, for example, or South Africa. And one of the other problems around crowding in the private finance, apart from this sort of sense of risk sharing, which I think has not been appropriately addressed, is a kind of technical issue around disclosure metrics, which are all backwards looking. So if you're trying to create using fiscally neutral tools like regulation to try to encourage private finance to participate in these kind of projects, you need to have a forward-looking curve so that although there's some investment, which means cost goes up in the early years, and also exposure to fossil fuel activity goes up as the plants or the mines need to kind of be brought offline in those early years. There's no benefit then to the drop off that comes after that. And that's something I think the ecosystem has been struggling with trying to demonstrate for the private finance side. The other thing we saw was that the private finance actors really wanted to participate more on the renewable side. So Heather, your question around how to balance the incentives for the buildup with the renewables, where there's higher expected returns financially versus the kind of cost outlay of closing down the fossil fuel activities hasn't been appropriately timed, balanced, and the set of policy reform that has come in the JETPs around the sort of the conditionality of all of that financing clearly hasn't delivered. Part of that is the political economy lock-in on the recipient side, which I'll come to. But what we've also seen is that there's other financial providers out there who are willing to provide finance for certain activities in a lot of these EMDs with fewer conditions attached. So we've seen in Indonesia, BRI and the Chinese government coming in to provide financing, for example, for nickel mining, where G7 donor countries, either through the JETP or otherwise, weren't able to move as quickly or on terms that were as favorable for the Indonesian government. And then I think it's a genius idea to think about the political economy of the vested interest and the sort of stranded labor costs. And that's something that I don't think has been addressed at all. I think that philanthropy has not been particularly creative or aggressive about this. There is a question, of course, I would say this, but the evidence is there. Climate philanthropy in a good year is somewhere between, let's call it $5 to $10 billion annually. We're talking about trillions of dollars on both sides of the equation, both the shutdown and the buildup, even up till the end of this decade. The scale is just not there from philanthropy to pay off in the way that you describe, Alyssa. So I think we have to think about more creative ways to address the suggestions around the kind of vested interest and the lock-in that exists in some of the EMDs. I hope that was helpful in terms of sharing some early thoughts, and happy to come back, Heather, with further questions.
Thank you very much, Yasmin, and I'm sure there will be more questions on this. That's a great overview of the challenges, public sector, private sector, and even philanthropy as well. I'd like to come to you now, Turaya, both because of your experience at the European Investment Bank, which of course is doing a lot in this area, also because you have a PhD in finance. So I'm thinking about the way that the whole financial sector can, and also just financing mechanisms, creativity in this area is vital, and also because you've just come back from Indonesia and Vietnam. So you can tell us how the JETPs are going, and whether what Yasmin just described as, you know, a new method, an experimental method of doing public finance by basically an alliance between particular donors for particular countries. And we've seen the way that the JETPs evolved from South Africa to Indonesia, Vietnam, and now there are further thoughts about how they could be, the model could be refined. How's it going? Are the JETPs something that could be used both for unlocking finance and also especially this issue of coal, which is fundamental in all of these three countries?
Thank you very much. Thank you for the invitation, the opportunity. It's on to speak. Actually, you asked different questions, so I'll try to break them down, starting maybe with the financial instruments. And maybe I will touch on the issue of innovation, but I'm hoping that when we're discussing climate finance, it's not only discussion on innovation. Sometimes the plain vanilla loans could work very well. So I always start the conversation by assuming that not everybody in the room knows and is familiar with EIB Global, which is the entity I work for. So I work for the European Investment Bank. We pride ourselves for being the investment bank of the European Union. We are owned by the European Union member states, and we invest both inside and outside Europe. In 2022, we created a dedicated director to our investment outside the European Union. It's called EIB Global, and that's where I work. So obviously, as EIB, we are very committed to scaling up climate finance, and we work, I would break it down to 4 work streams that we are involved in. Of course, a critical game changer and ability to deliver impact and results are the mandates and the collaboration with the European Commission that we benefit from, and that's, of course, critical to our delivery model. The strategic framework under which we operate is Global Gateway Greenwheel, so we are mandated, and our focus is to deliver on EU priorities and policies and values. So to achieve these objectives and also help scale up the climate finance, the first work stream we're involved in is to support public sector investment to deliver what we call public goods, or investment that create the enabling environment for the private sector to come and invest in renewable energy. Our value added in this space, usually our ability to provide long-term financing. We are increasingly trying to provide also local financing, because that's an issue that keeps coming in the conversation. They ask from countries. We try to innovate by blending our own resources with grants from European Commission, from member states, and also use financial engineering when it's relevant. So we are, for example, we have recently approved our first debt for nature swap with Barbados, and we are hoping to sign that very soon. We are also trying to design an offer that also address differences between countries' needs, because what works in Burkina Faso may not work in India and may not work in a small island development state. So, for example, for the SIDS, we are trying to, because of the issue of small side and remoteness, we're trying to aggregate through players. We're trying also to ensure that we are aligned with the concessionality requirements of the IMF. So that's the first work stream. The second work stream is focusing on private sector. So of course, there is an expectation that 70% of the climate finance gap will be filled by the private sector. So our financial instruments entail the provision of long-term resources, because sometimes it's an liquidity issue or an issue of maturity. I mean, I used to work for the African Development Bank, and I remember I did a very interesting survey showing that 60% of loans provided by banks in Africa have a maturity of less than 1 year. So there's no way you can invest or talk about investment with such maturity. So maturity lengthening is an area that we work on very actively. When it's an issue of risk, we try to use other instruments, be it portfolio guarantees. We try to the extent possible also to see how we can come on higher risk tranches. Of course, when we talk about the private sector, and that needs to be unpacked. We work, of course, on project finance, on corporate to facilitate investment in renewable energy projects, on public-private partnerships. But we work also extensively through financial intermediaries. And this is particularly important because the reality is that we need local solutions. Greening the financial sectors and ensuring that the banks who are providing and the financial intermediaries who provide the bulk of the financing for the economy and for the real sector are actually equipped with the right instruments, with the right understanding to provide financing is very important. So that's something that we are active in. We provide lines of credit that are increasingly targeting. And of course, when we can, we provide built-in incentive to cater to the needs of particular segment, being youth, women, rural population, agriculture, because again, I go back to the different needs. Today the market for renewable energy does not need the same level of concessionality than agriculture and small-scale producers. So that's where we need to have a differentiated approach. Third work stream is to build a pipeline through using our own technical expertise. We have an entire department of engineers, but also working closely with the European Commission on technical assistance with donors so that we can build a pipeline of investable projects. And that's one of the biggest problems, and I'll come to that in a second for Indonesia and for Vietnam. The fourth work stream is us working to ensure or enhance the efficiency of the system. We are involved in a lot of important discussions. We've been involved in the development of the MDB methodology to track and report. I think Yasmin highlighted very well the issue of being able to quantify what is the gap, what are the issues, what are the costs, so that we all have the same level of understanding. Evidence-based policy decision is extremely important. We are also involved now in the MDB reform discussion, the financial, the capital adequacy framework, how to unlock the capital and the balance sheet of the MDBs. So these are important discussion. Of course, part of also of our approach entails building partnership with the UN system, with Team Europe, other members, so that we can, as European at least, come together and provide an offer that is compelling. And that leads me to the second part of your question about the JETP. So I just came back from a Team Europe mission to Indonesia and Vietnam, focusing on JETPs. So few takeaways from my week in Asia. We are also involved in South Africa, so we have $1 billion pledged in each one of the JETPs, and we're very much committed to deliver on this. The JETP model, as mentioned in the brief, it's a Just Energy Transition Partnership, which is a partnership that is, I would say, promoted by the International Partner Group, a group of like-minded countries who want to come together and support the green and just transition in a country. And 3 countries have been selected as pilot: South Africa, Vietnam, and Indonesia. So first, this model of JETP, meaning different partners coming together, trying to work on a common goal, putting their different instruments so that they can make progress, proved is a very interesting and good model. Why? Because one of the biggest issues is fragmentation. So it goes back to what colleagues have said already about also the political economy. We all have our own flags, our priorities. So coming together and say, okay, we are all going to work together in a coordinated manner is very important. But the progress also depends on the effectiveness of this coordination, which requires time and money. And here I would like to salute, among other things, the work that the European Commission is doing to fund the Secretariat, for example, for the JETP, because that's also important. There is a cost to coordination that needs to happen. Second interesting message, I spent a week talking to all the ministries involved. In the heads, maybe so the JETP is sold as a brand, and it came with this idea or expectation from the country that they will be receiving plenty of grants, and it will all be concessional money. So regardless of how much grant you put, I remember very well the figure for Vietnam, 137 billion. That's how much they need for the just transition. There is no way we can provide 137 billion of concessional and grant money. So the discussion needs to be on where this grant money is needed most, how can we prioritize, and what other tools can we use to unlock financing. So the big question that came was also, what is the value add and the additionality of the JETP? You would have done these projects anyway. So articulating this value added was one of the things that we did during the mission. Third, we did the Team Europe mission, which proved also to be very successful. And I hope that we can do more as European, coming together, showing the breadth of our instruments and the complementarity. It was very nice to see European Commission working on the policy side on reforms, which are very much needed because the private sector will not come and invest if there are no clear feed-in tariff. There is no predictability. There are issues of local content requirements, and also lack of clarity about the fiscal treatment of different things. So this is the foundation. At the same time, it was nice to see colleagues from some European countries providing grants, EIB coming with a loan. So that also was quite interesting. There is progress. So the message also that I want to leave you with, that there is a lot of commitment and willingness from countries for the just energy transition. They see the value, and they see also the opportunity, and they are very much aware that without that, they will not be able to sustain the trade and the investment with Europe. So the European, because of the CSRD regulation, because of the CBAM, so they understand it. The message that we were left with was, we need time and we need money to be able to adjust. There are also projects. So for example, in Indonesia, we are working, same in Vietnam, we have our first project that we are hoping to bring actually to the board. So there is progress, but probably the progress is not at the pace that we wanted to, and that the private sector wants it. How we reconcile both is actually, reconciling timeline is one of the challenges that we are facing. And link it to these timelines, the issue of just transition, which is very much on their mind. Yes, for green energy, but how about the just transition? How are we ensuring that we shield the worst off? And remember, some of them are, most of them are policy makers. They have elections coming. So for them, the social angle is extremely important. So we cannot have a green transition discussion without the just energy angle. Thank you.
Thank you very much, Toraya. Yes, and this is a key point about this paper, is arguing that it's also worthwhile funding the social costs. There is an economic case for funding the social costs. It's not just charity. This is actually something that would bring back financial returns. So, Alessandra, I'd like to turn to you now from the Commission perspective, but also your own background, your doctorate in sustainable development, your work also at the UN Economic Commission for Africa. How can what the EU has to offer guide capital flows towards low emission, climate resistant development? How can it actually be a development conjecture as well as a financial one? This last point that Toraya made is really fundamental to ensuring that it will continue from one election to the next. Very glad to know your view from the Commission.
Thank you very much for the question, but above all for inviting me to share some of my thoughts around how we can unlock the trillions. And I think we've heard from the previous speakers the challenges and opportunity that we are facing. I'd like maybe to start from one of the points that was raised by both Yasmin and Toraya. We cannot expect, unfortunately, that public finance alone will be able to fill the investment gap that we see. And I'll come back to that towards the end of my introduction, of my intervention. Maybe where we see the huge potential for mobilizing the trillions that we need is around operationalizing one of the articles of the Paris Agreement, this famous or infamous, as you want to see it, Article 21C, which really calls for making sure that we have a consistency of all financial flows with the objectives of the Paris Agreement, both in terms of keeping the temperature below 1.5 degrees, but also making sure we invest in climate resilient pathways. And that's where the EU is really focusing a lot of efforts, both domestically and internationally. I think there are reasons for hope. Both the IPCC, the latest IPCC report tells us that we have sufficient capital out there. What we need to do is make sure we shift it to where it's needed most to accelerate the transition, the climate resilience and low carbon transition. We also see, according to the latest report of the Climate Policy Initiatives, that actually global flows towards climate finance have more than doubled in the 2021-2022 biennium compared to the previous biennium, and they've reached 1.3 trillions. So this huge progress that we have seen at the global level, but we also are very well aware of the constraints that we're facing. If we look at the global flows, for instance, we see that 90% is actually flowing to Europe, the EU, Japan, and the major emerging economies, India, China, and so on and so forth. So there's a huge geographical gap that also needs to be filled. At the last COP, I think the message from parties was quite clear. We do need to make progress on aligning all finance flows if we are to address the gaps. We need public sources to unlock and mobilize private investments. We need private investments in itself to be shifted to the transition that we want to see. And this is really a fundamental from our perspective. I would invite you to look at a recent report we have published that outlines the efforts of the European Union in these regards, both domestically but also what we do in terms of international cooperation and partnerships with third countries. Just 3 key lessons that I want to highlight that we have learned in terms of what we do in the EU in these regards. And the first is that we need to have a clear and firm political ambition that goes beyond election cycles. And I think, the country's nationally determined contribution is certainly the top document at which investors as well as the international partners look at to make sure that we are aligned with the ambition. But we need to translate that into clear and actionable targets that are both at the sectoral level as well as the whole of economy. And that's the only way in which we can start moving towards the implementation of the political ambition that I've just mentioned. And finally, the third lesson is that we need an implementation framework that is accompanied by an underlying economic and financial analysis that look at how the different sources of finance, including, and most importantly, perhaps domestic budgets, can actually deliver the resources that are needed. So all of these together are really necessary and conditio sine qua non, for making sure that investment decisions of both the public and private authorities and actors are guided in the direction that we think is needed to make sure we meet the targets of the Paris Agreement. Without going much into the details, just a couple of words about how we in the EU have translated this into practice, knowing that there are, of course, gaps and that we can still improve on the policy and legislative framework that we have. We have a clear ambition and emission reduction targets as enshrined in the Green Deal and translated into sectoral policies. First and foremost, of course, the Fit for 55 as well as the ETS, which are the cornerstone of our climate policies. And I think the political guidelines of our Commission President has clearly emphasized that we are set to stay the course in terms of mitigation ambition, but also in terms of resilience within the EU through the development of an adaptation plan. We have the sustainable finance policy framework that I think has been mentioned by some colleagues before, that is really meant to address the other side of the coin. So how is it that we direct the private sector towards green investments? So around taxonomies, of course, to define what is a green investment, around disclosure to make sure that consumers, investors, but also corporates can actually make informed decisions as to where the financial resources go. And most importantly, we are currently working on strengthening our transition finance work. I think some of you mentioned that this is really an important step to make sure that we are moving towards a forward-looking approach and not only backward-looking in terms of disclosure. So how can we provide instruments to corporates and investors to check whether the transition plans that corporates and countries as well set in place are actually aligned with the 1.5? They are robust and they can be invested in without creating stranded assets, for instance, or transition risks for companies. So these are all some of the aspects that we do. A couple of numbers that I wanted to share with you just to demonstrate that even if the sustainable finance framework is relatively new within the European Union, it has already started to deliver a very strong mobilization of private sector capital. So let me just check my notes so that I don't give you the wrong numbers. I think what we see, for instance, that all the companies that have started reporting on the taxonomy alignment of their portfolio portfolio, in the first 4 months of 2024 have already reported almost 250 billions of investments that it is taxonomy aligned. And this is 60 billions more than the whole of 2023. So I think this clearly demonstrates that it is moving in the right direction. Green loan volumes have been increasingly steadily, and I think in 2022 they've reached almost 60 billion, so that's also quite a significant investment. And we see a continuous increase in the issuance of green bonds that have reached 6.5% of total corporate bonds last year. And in terms of volume, the EU governments alone issued 266 billions in green loans in 2022 alone. So I think this clearly shows that domestic policy frameworks do matter. Of course, international cooperation is necessary, but you do need to have the right policy framework in place domestically to make sure that you bring all financial resources to support the climate resilience and low carbon transition. If I may, a couple of words of how we translate that into our international cooperation. I think we work with our partners on all these fronts. First and foremost, by making sure that our public finance is actually supporting climate action in third countries. And I think the European Union, with the EIB and the member states, remains the largest contributors globally in terms of climate finance. I think we stand at around 28.5 billions in 2022, and we should soon have the figures for 2023. And we achieve that through making sure that we mainstream climate action throughout our activities by both having specific climate spending targets, but also making sure we implement the do no significant harm, so that everything we do with third countries is fully aligned with the objectives of the Paris Agreement. Secondly, we also support the mobilization of climate finance, and I think you spoke quite a lot about the instruments that we have under our Global Gateway framework in particular, which is set to mobilize 300 billions to support investments in strategic infrastructure that is conducive to helping partners achieve the twin transitions, digital and green, of course. And the European Fund for Sustainable Development is really setting out to mobilize with an initial capital of 40 billion, around 135 billions, if I'm not mistaken, in private and public investments. And of course, climate action is one of the core pillars of the EFSD. But we're also helping, sharing our experience, and with that, hoping to help countries mobilize finance from the private sector and direct, rather, investments from the private sector to the green transition. The International Platform on Sustainable Finance, for instance, that quite a few of our international partners have joined, is providing a space for countries to share experiences and learn lessons, and in this way accelerate, if you wish, the deployment of taxonomies and reporting requirements that are fully aligned and interoperable, so that we can actually create a global level playing field. And of course, we are looking at how we can implement the recommendations of the high-level expert group on sustainable finance that delivered at the beginning of this year, if I'm not mistaken, to see how that can inform further our engagement with third countries. Last but not least, we also need to work on new sources of finance. I think it's quite clear that we need to enlarge the pie, and that's why through instruments like the Global Green Bond Initiatives, we also support in the mobilization of additional resources in partnership, of course, with the European Investment Bank, and we're engaging with international initiatives like the Global Solidarity Levies Task Force that is looking at how we can tap into sources of finance that haven't yet been mobilized for climate action and for development as well. And I think this is, I hope, a promising avenue for us to really mobilize additional resources at scale. So just to wrap up, domestic policy frameworks remain crucial. Aligning finance flows with the goals of the Paris Agreement is not only something that we have all committed to as parties when we signed up to the Paris Agreement, but is also something that can unlock opportunities for growth and investments, and therefore something that we really support both domestically and internationally. And looking at how we can identify synergies between climate policies and sector sectoral policies remains critical. I think, in the current time of a budgetary crunch, both for developed countries but also for developing countries that face that crisis, quite strong that crisis, achieving more than one objective, which with each euro or dollar spent remains for us the most effective way forward. If I can comment on the Just Energy Transition Partnership that have been mentioned quite a bit, just a very short comment from my side. I do believe that the JETPs can deliver. This is my firm opinion. I mean, it is true that I haven't delivered at the speed that we were hoping, but I think we underestimated the importance of the policy reforms that we need to see to create the environment that enables the mobilization of financial resources from the private sector, but also the deployment of international public support at the local level. These things take time, and of course, changes in the political leaderships in many of the JETP countries have slowed down the process, but I think we are really having a model that brings together all the three aspects that I have mentioned, political ambition, investment plans, and clear sectoral policies and targets, and that can really help us achieve impact with the resources that we can put on the table.
Thank you very much, Alessandra. I think what we're getting is a very clear picture of commitment and interest and engagement by all kinds of public institutions, and real concern about time running out. But all of the figures that you're quoting are so far away from the financing needs that Alyssa started with in the initial presentation. The scale of the gap is just staggering in terms of how much is needed. I mean, Alyssa, you were quoting that just for coal and just public finance, it should be 190 billion annually. Right. And we're talking in the low single digits of billions for individual countries for their entire energy transition. And so I think that the gap in terms of simply scale is just phenomenal. And I wonder if I could invite you, Alyssa, to comment on that. We've talked about the many ways in which this could be done, the many methods that the EIB is using, the Commission is using, national governments and philanthropy are using. But it's a quantum leap to move to a new quantified goal, which is actually achievable. So, Alyssa, what do you think about this question of scale?
Yeah, that's a great question. And if you don't mind, I would actually like to go back to my one slide on this that I think would illuminate it, if I can briefly get it back on by the support team.
Is it the last one?
Yeah, not the last one, the one before. Let's see.
Could you just put up the slide? Great.
Yeah, thank you. Yes, so I guess this is my one slide on just energy transition partnerships. So maybe, to answer your question, let me first take one step back. The question is, right, first of all, what is the climate crisis? It's a scale problem. So if you've listened to the latest Bill Gates documentary on the climate crisis, you hear Friedman from the New York Times say, climate change is a skill problem. So if we want to solve climate change, little efforts are simply not enough. They're drops in the bucket. And then the question is, what are the different tools we have at hand to reach scale? Obviously, one would be carbon taxation. We should try to advance it as much as possible. I think the EU is taking the lead with its energy transition, European trading scheme, and also with CBAM. But in some sense, thereby implementing the idea of William Nordhaus to create climate clubs, right? And other countries can also adopt a climate club. And the more countries would do that and have a carbon border adjustment mechanism, the more also other countries that would export to the EU or these other clubs would be incentivized to decarbonize. But of course, that is also by some said to be unfair, because CBAM makes exports more expensive, and if you're already a less wealthy country, that adds to your sort of burden. So I think climate finance is also very important as a complementary tool to carbon taxation and to these climate clubs. And in some sense, the way I conceptualize just energy transition partnerships is as climate finance clubs, like the carbon clubs of Nordhaus, these are coalitions of the self-interested willing. And just to explain a little bit more what JETPs are, because there was a question about it, right? What we show here is that a typical JETP has a group of financier countries that have organized themselves in the international partner groups. So many of the JETPs have had as their financier countries something like the G7 and the EU, and sometimes a few other countries. And then a recipient country that also voluntarily chose to partake. And here we have, as you mentioned, South Africa, Indonesia, Vietnam, and Senegal as the first cases. Why are these JETPs also so important? Because we are moving towards a new model where we're not just doing project-based finance for, let's say, building out renewables, which simply will never deliver the scale that we need. If we are thinking about a countrywide transition, it will have to be planned at the country level. Why? For example, you cannot just phase out coal without having a plan for what to build in its place. So there are papers by Olivier Darmoni, for example, at Columbia University, showing that there was private divestment from coal assets in Europe, but countries like Poland ended up buying it because they couldn't close it if there was no place for plan for what to build in its place. Similarly, you cannot build renewables unless you have a plan for how to connect it to the grid by doing grid extensions, sufficient batteries, and so on. So what you really need is a system-wide plan and system-wide finance. And I am, like the people here, bullish on JETPs because they are the first of their kind system-wide finance deals, cross-country funded from advanced country coalitions of the self-interested willing to self-interested willing EMDE that decided to partake. And as far as I'm aware, these are not the only countries that have expressed interest. There are countries like Kazakhstan, Colombia, that also, and many others that have expressed interest in these deals. Now, what are in my view, the key, what is the blueprint of this deal, or how you think about it? And here we need to mention one important thing is that the new quantified goal of climate finance is also very important because we have the new setting of the nationally determined contributions coming up in 2025. This only happens once every 5 years. And many EMD economists argue that they cannot set ambitious NDCs unless they are properly funded by nationally a new quantified goal of climate finance that is sufficiently ambitious to be able for them to implement their plan. So the way that we think about it, and then I'll get to your scale question, and I have actually a new study coming up, which I haven't yet brought out, but will come out soon, on climate finance to decarbonize the power sector in each country more broadly. So conceptually, right, like how do you think about this and how do you match this with NDC ambition? Well, you would say, okay, what is the country's current energy mix? And let me, by the way, say we're talking constantly about climate action. That's fine, but there was also a complaint by Nobel Prizes because from all emissions annually of 42 gigatons, 37 comes from fossil fuels. So let us also be clear that climate action has to be focused on phasing out fossil fuels and replacing that with renewables. So that's why I'm focusing here on the energy sector. So you look at the current energy mix of each country and you ask, how would the emissions need to come down, not just to be net zero by 2050, because that's oftentimes not aligned with 1.5 degrees certainly, but can you make that pathway ambitious enough to globally make sure we stay within the carbon budget that we aim for, let's say 1.5 degrees or 1.6. So you have your phase-out pathway, and then you say, what would emissions, what is the projected energy demand? So you basically want to, as a country, specify what is my phase-out pipeline, which assets would need to be phased out over time of fossil fuels to be able to implement my emission reduction targets, and what are the renewables plus complementary investments into short and long-term storage and grid extensions to be able not just to replace that, but to keep up with growing demand. So you basically formulate a phase-in pipeline. And then I'm coming back to, I think it was one of your remarks, which said, we need to have detailed implementation plan, so we need to formulate that phase out and phase in pipeline and the pairing of that, not just phase in, also phase out. But then the next step is obviously like, how do you finance those phase out and phase in pipelines? And I have actually, for my climate finance course at Cornell, worked with various partners of the JETP deals, including in Indonesia, the Climate Policy Initiative. And one of the things that is striking is that, you know, grants indeed are provided to some extent, but it's a very small percentage of the 20 billion for Indonesia. And not enough is actually offered in terms of grants to close coal early. So because that is not offered in sufficient extent, what you see is that these countries are now considering routes such as, you know, can we sell carbon credits for avoided emissions of coal? And it's not obvious that that can be sold at high enough price. It's also not obvious that that's necessarily gonna be additional, because what we really need is absolute emission reductions. So one of the hamstrings of you know, implementing these deals also in South Africa is that actually no money is provided, or hardly any money is provided for grants to close coal. Whereas, for example, in Indonesia, you cannot bring renewables on the grid because it's already oversupplied with coal. So anyway, so what we find in our paper is that, you know, if you compare what is being offered in the JETP deals, for example, South Africa is 11 billion, Indonesia 20 billion, Vietnam 15 billion, compared to what is needed. So let me focus on Indonesia and Vietnam. It's 20 billion offered versus what we say up to 2030 is 97 billion needed. Vietnam is 15 billion offered, 134 billion needed. And that's, you know, to not just set a slightly more ambitious NDC, but really align it with the net zero pathway. So our estimates are clearly higher. But then I think the important, and just to be clear, right, what do our estimates consist of? The grants for early closure and the 25% investment cost to crowd in private capital. Now, to the question of, you know, how do you get scale and is that actually feasible? One important point that I didn't get around mentioning in my presentation is that it's not just a net economic gain to advanced countries to offer climate finance to EMDs like Indonesia and Vietnam at scale, and I'm saying at scale, it's net economically beneficial at scale, but also importantly, it's actually fiscally affordable. So if we look at the slide here, which is a bit small, but I can explain, you know, the total, the total fiscal cost, if you were to do this at scale to pay for the entire decarbonization of all EMDEs, excluding China and developing countries, annually is 0.32% of G7 plus EU GDP, not even all developed GDP. So it's annually 0.32% of GDP. So it's totally affordable. So the important part, and this is where I will conclude, is we have 6 years of carbon budget left. So these are the 6 critical years. And doing small deals is a drop in the bucket. So if we are serious about implementing and pursuing the goal of the Paris Agreement, we have no choice but to get scale. And luckily, it's also in our economic interest.
Indeed. So we're going to come to questions now, and I'm especially keen to hear from those of you in the room from the private sector about whether the economic case that Alyssa has presented is also a business case from your point of view. And we also have some questions online. For those of you online, I apologize that the sound apparently has been quite low for some of you, and so just encourage the speakers to speak into the microphone and also asking your questions here in the room into the microphone so they can hear you. And you can ask a question on Slido with the hashtag climate finance. So I'd like to start here. Question. Just remind us who you are and speak directly into the microphone.
Thank you. Shifa Dixon, I'm Second Secretary Economics at the UK Mission to the EU. So as I see things, the political economy of climate transition really is energy prices. So what changed in 2022 is that you could say to your domestic audience, by investing in the transition, we're producing renewables that will cut your energy prices in half. So my question to the panel really is, what are the more immediate wins that you could sell to domestic audiences? Because I don't doubt at all that this is a public good that needs to be secured, but how do you present the public good as actually being a public good in the interests of the domestic audience? So one option to start you is the managing migration flows. Is there a case to be made there? But I'm sure you may have others.
Right. Question here.
So this is a question mainly for our two panelists from the EU institutions. So, it's quite startling that the money we allocate to support international climate action in the EU is in order of magnitude smaller than what we allocate to support the Green Deal, even though in the end, a saved ton of CO2 is a saved ton of CO2 regardless of where we save it, and there are sort of strong economic arguments to suggest that it's actually cheaper to retire or prevent a time of CO2 in emerging markets. My question is, why do you think this is the case? So why do we have this enormous discrepancy? I think our colleague from the EIB made a sort of a telling comment, which is that the amounts of funding that were expected by a country like Vietnam, I think it was, over 130 billion was simply, a no-go, right? Simply absurdly high. And I suspect the reason why you said that is because you were comparing it to the very available budgets, right? So to essentially for example, at the EIB level, whatever lending you can allocate to a single country. But of course, the question I'm asking is, why are these available budgets the way they are? And so if you could speculate about this. So again, I'm asking about the proportion. So just saying we don't have enough money it doesn't work, because it is the discrepancy that is starting.
So, Thoraya, would you like to start on that, and then I'll come to you, Yasmin, online on both of the questions.
Can you hear me well? So first, we should be on the slide because we are funding the 3 JETPs. Yeah. Good questions. The one on public good. So obviously, as a government, one of your roles is to ensure that you are delivering or improving the livelihood of your citizens. So that's the very raison d'être of a government, is to ensure that all the public sector services work properly. I think by today, given all the adverse climate events, we are all convinced of the pressing need to invest in building resilience to climate change. So that's the first argument, is to ensure that your citizens are happy, and that's important for policymakers, because when they run elections, happy citizens vote for for the candidates that are able to deliver. You're right, the argument of also controlling both forced and voluntary migration, because people can migrate, one, because they cannot see any economic opportunity, so they decide to leave, cross the Mediterranean in a legal manner to reach Italy and then to Europe or to other places, or they can actually be forced to migrate to other places. And this is, for example, the case of pastoralists that are affected by climate change because their animals are starving, so they have to move anyways. And water has been a major source of conflict in a lot of places, notably in Africa. So these are the arguments. But perhaps one takeaway from this discussion, or two messages that I would like to pass. The first one, I feel that there is a strong need also for evidence and data about the gaps, about what is working. I mean, today, we are not necessarily able to have a place where we can all agree on these are the investments that have the biggest impact. These are the climate adaptation, for example, investments that are economically make sense for someone to go and borrow money, whether it's an SME or farmer. I mean, we talk about taxonomy. Taxonomy is done for eligibility, for tracking, but we're not necessarily using them to unpack the economic case for those who are providing the money. Now, the question about Vietnam and Indonesia. I mean, if I want to be provocative, if tomorrow we mobilize 137 billion, Vietnam doesn't have the execution capacity, something that we did not at all mention in this conversation. So we need to be careful and avoid being supply-driven, because we can put all the amount of money available there and we can increase it by 500%, but when there is no demand, willingness So that's why I talk also about the evidence and building the case and explaining to an SME what is the benefit from energy efficiency. And second, also building addressing the issue absorption capacity, be it financial because of the debt issue, but also the execution. There's a lot of good evidence in the brief, but when I look at it also from an EIB perspective, for us to be able to implement a project, we need to abide by very rigorous ESG standards. We need to make sure that displacement is properly done. We need to prepare, and these things take time. So actually I get very nervous when I see this 6 years left, because the reality takes us sometimes more than 6 years to prepare a project and ensure it's properly done. So that's one of the reasons why I said there's no way. It's not because we are not, obviously there is an issue of supply, but there's also an issue of absorption and implementation capacity if we want to do things properly. Now, my argument, and I'm sorry if I was not clear, my argument was not that there's no way to provide 137 billion. Actually, that's not a lot of money if we can coordinate and we can bring everybody around the table. Actually, as Stephanie was speaking, I tried to Google how much assets under management are available in the financial sector. 145.5 trillion. So actually, we can solve the problem and all go home. The issue is the terms, the risk appetite of this money. So, and these are things that so my argument earlier was an expectation from this country that it will all come in the form of grants. So there is no way we can offer 137 billion in grants. What we need is a financial package that includes grants, commercial loans, concessional loans, so that we can cater to the needs of different projects. So I'm sorry if that was not very clear. And of course, as EIB, given our model, we are AAA. That's very valuable for us to be able to raise money, and that gives us the scale. For us to preserve it, we can take a certain risk. We have also what we call single obligor, meaning that we cannot put 100% of our funding on a single country. That's where the mandates from the European Commission play an important role in de-risking, and that's where issues of risk management become important. So if we want to, and I would probably conclude with that, if we want to solve the problem, we should not get discouraged by the scale. So we have made progress. The figures are showing that we are making progress. Money is there in the system. What we need is to ensure that the money gets to the investment what we need. Hence the importance of taxonomies, hence the importance of financial engineering, of regulation that force them, of bankable project. It's only through a coordinated approach that we can make a difference, where we can put the grants, we can put the philanthropy. It's 100 billion, but still, if you put 100 billion with 500 billion from us and we work together, we provide the first loss and we do the rest, that's already a big amount of money. Coordination, working together on a common goal, and being realistic about what we could do, address both the supply, the demand, and the regulation framework is the way to go. But that requires, again, coordination that today is happening, but not at the scale that we want.
Thank you very much, Thoraya, for reminding us of some of the realities of doing projects on the ground. Yasmin, I wonder if we could come to you, particularly as you're a former official who's able to speak quite freely about the political economy of all of this, to address Yeremin's question about, okay, we're spending a lot more money, a whole magnitude of difference in the European Union as opposed to the financing for reducing carbon emissions, particularly through coal phase out in the rest of the world, where it would be cheaper to do that. Does that make sense in terms of political economy, especially given the first question about how to keep voters on board? If they believe that all the money is being spent outside their country, there will be a massive loss of support for climate action? And is that enough of a justification, really, for the disparity in financing, or should we be focusing on the most cost-efficient methods?
Thanks, Heather. Look, I'm happy to speak briefly on this, but I'd really much rather the practitioners on the panel who are in charge of delivering against some of this have time to speak. The thoughts I'll offer are the following. Jerome's question is really about sources and uses. And we've talked about the uses a lot today. What we haven't talked so much about is the kind of array of sources and how to maximize how to really maximize those for the financing that goes abroad versus the financing that goes into a domestic economy, in particular from the donor side. And I think, there's a gap in terms of understanding and in terms of coordination there, even just domestically. Thora, you've been talking a lot about coordination between governments, between institutions, but actually, I'm not sure the institutions that are responsible for financial and economic sort of policy making, even within G7 countries or G7 plus countries, are as coordinated as they should be on the domestic versus international question that German is asking about. And this connects to the first question, which is how to basically align the political incentives that policymakers are driven by with the sort of large costs of financing that are associated with transition when you add up home and abroad. And I think policymakers are trying, and this is sort of what I referenced in my first comments at the beginning. That Alyssa, your paper in making the case for the economic benefits to the G7 countries by investing in transition and decarbonization in the EMDs is so important, and quantifying that even. I think time frame is something we need to think carefully about, in particular around showing that impact and that cost benefit. And the second is the sort of wave of what I think some people are calling green industrial policy that we've seen coming out of the US, and the sort of big debate now through the Draghi competitiveness report in Europe, Future Made in Australia policy in Australia, and the ecological transformation plan in Brazil, and sort of, I think the list goes on and will carry on further, where governments are trying to grapple with creating a political kind of narrative that encourages and supports with their voters the economic case for investment in transition and decarbonization, among other things, at home. And critically, what needs to be expanded on is the part where that only works if you're also making investments in other countries, in third countries that are outside of yours. And so for me, the more the group that's sitting on this panel, and all of you at Bruegel can contribute to supporting making that case, both with political arguments, economic arguments, and frankly, the climate ones that I think many of us in the room understand, which is that no matter, German said, okay, carbon emissions removed wherever they are good. We know that the most are going to be coming from the EMDs. And so it's really just not good enough for G7 plus countries to be focused on themselves. I think we're necessarily going to be pushed in that direction because of the reality of climate change impacts. And so the sooner that we can sort of get policymakers on board with that reality, the better.
Thanks very much. Alessandra.
Thank you very much. I think a lot has already been said, so I will not repeat, but I do want to react to a couple of points that were raised, and in particular on the financing gap that we see for the Just Energy Transition Partnership. I think we're starting from perhaps a biased assumption that the offer that the International Partners Group would put on the table would actually meant to cover the full needs of the transition in the partner countries. I think this was never the understanding, and to the contrary, the initial capital that the IPG has put on the table together with the private sector and the G funds was always meant to be seed money, if you wish, to foster the reforms that we need to see at the domestic level to really attract the investments that are needed to fill the gap. And I think this is, we're underestimating the importance of this first step. As Turaya was saying, the issue of making sure that countries have the conducive environment to attract investment, but also the ability and the capacity to spend resources that are channeled is really critical. I mentioned at the beginning that we have already 1.3 trillions of climate finance globally, and the vast majority actually flows to developed countries, China, Brazil, and India. So we really need to work on the reforms because that's first and foremost a domestic responsibility, and it's really a necessary condition to make sure that countries can attract the funding that is needed, both from the international public side, but above all from the private sector, because let's face it, private sector, I think, will have to come on board much more strongly. The capital is out there. I think I forget which figures you quoted, but great, but clearly we need to make sure that it goes to investments that are fully aligned. And let me emphasize again the importance, as you were saying, of legislative and legal and legislative frameworks around disclosure, but also around transition planning, making sure that resources are invested in capitals and assets that are not going to be stranded in the future, or that don't, above all, lock us in an unsustainable path, basically.
We haven't even mentioned one other source of finance, which is the subsidies that currently go to fossil fuels, especially in advanced economies, but in fact in all economies, that could be redirected. And those are subsidies that have doubled since the invasion of Ukraine by Russia in Europe. So I'd like to take the last two questions over here rather briefly. There's one here and one over there. Could you just remind us of your name and affiliation?
Hi, I'm Nicole Reynolds. I'm an associate fellow at CEPS, and this is a topic I work on at CEPS. You mentioned, Alyssa, that between now and 2030, 1.3 trillion is needed to retire coal, and then another 2.6 trillion up to 2050. If my math is correct, that's about 5 trillion, and perhaps I missed it, but did you also do this analysis for retiring the rest of the fossil fuel assets? Because that would be incredibly important. Because if, say, it's roughly double, to retire all fossil fuel assets, well then, we're talking somewhere $5 to $10 trillion when, in fact, there's 145 trillion in the world. It seems like we ought to be able to find the money somewhere to wind these down. So I was just wondering if you had extended your analysis to all fossil fuel assets.
And question over here. And I should just mention online, there's a question actually also about gas. Is there, in addition to phasing out of coal, what about phasing out natural gas, which is prioritized as a transition energy source by several countries? So I'll just mention that one.
Thank you. Hello, Peter Gedikov from Positive Money. We're an NGO that focuses on monetary policy. I think you've laid out the scene pretty well concerning both the investment gap and the financial constraints that come from the fiscal situation of most EU member states in particular. I was wondering, this is a question for the entire panel, what your opinion was on extending the possibilities of financing to either monetary and fiscal coordination, or simply having the European Central Bank trying to incentivize green investments. First, interest rates are pretty high right now, and having them lower, for instance, to finance green projects could be an option, because it's within the ECB's mandate to support EU goals, especially the climate neutrality goal that we have currently.
Okay, thank you. So, role of central banks. Alyssa, we've just got a couple of minutes, and then I need to allow you all to go and get some lunch. So we'll just have some rather brief replies on these last questions to wrap up.
So I'll leave the last question to two of you. I might try to take a step at the first two. At the first two. So yes, I actually have a new study coming out on all fossil fuels. So we are working really hard to try to get that published before COP29. I'm happy to inform you. Also on gas, I had a discussion about this with my students in my climate finance course. In our baseline paper, The Great Carbon Arbitrage, we actually consider, what would be the net economic gain of replacing coal with natural gas, and we find it's negative because you have a smaller emission reduction, and actually new gas plants certainly are often more expensive than renewable ones. So I am very much against the idea of natural gas as a transition fuel, especially with the rise of AI demand. We need to meet that with renewables, and natural gas has to go down too. So I think natural gas as a transition fuel is bogus. But anyway, that's my opinion. Just, to mention something important, which is in our paper, we take into consideration that the cost of renewables have fallen exponentially over the last decades, in contrast to fossil fuels, which are non-learning technologies. And that also, by the way, holds for batteries. They've become exponentially cheaper. So actually, we expect that if we are able to offer climate finance at scale this decade, we will have deployed renewables to such an extent more that these learning by doing effects as a function of global cumulative deployment will have likely made renewables cheaper, including batteries, and competitive with fossil fuels all over the world. So we may actually not need to extend climate finance beyond, let's say, 2035 or so, whenever that cutoff point is, till 2050. So our estimates are very conservative. Then maybe just one small point in relation to the remarks made earlier. I fully agree with you on what you mentioned on value added, and I also very much agreed with you on the point, you can supply the money, but there needs to be an implementation plan. And I think this is exactly what I'm working on in my research, but also the role, I think, of a multilateral development institution is to work with the country to establish that plan, because then, so that you can match finance with that plan. But on the point of seed funding, we've actually done some research in this paper with Jeremy. Yes, you're right. It's not necessarily the case that advanced countries have to provide all the public funds to crowd in private capital. But what is important is that countries set an NDC that is fully carbon budget aligned, and that there's then a discussion between international financiers and the recipient country. What part am I paying? And what part are the international financiers paying? And indeed, what does it take to deploy that, whatever, 130 trillion number to not just investments in developed countries, but EMDEs? And so the key thing is that even though renewables are cheaper than ever, they're not deployed, private finance is not being invested in EMDEs because of high cost of capital. And that's exactly why you want to use public funding to de-risk, so that with blended system-wide finance, you can essentially reduce the cost of capital to make it attractive for private capital to come in. But also, many of the international investors don't have the expertise to invest in EMDEs. So you really want, that's I think why also the JET idea is so important. You can help create the pipeline of bankable project in collaboration with the international financier, the recipient country, and the MBD that helps form this investment plan. So you can even pool assets together so that it becomes a standardized asset to invest in. So let me pause here and let the two of you respond to the third question.
Okay. Alessandra.
Thanks. A very, very brief answer to and a couple of comments to the questions that were raised on the issue of the role of central banks. I think we also have participants. Perhaps during the lunch we can discuss that further with some of you who are working in central banks in the member states. But that's, I think we have a sustainable finance framework that has just been completed, and in fact we're working on the last bits and pieces of it. We need to take stock of where it's taking us, and that's what we're doing, and we're certainly considering and exploring all the different options that we have on the table that could be implemented across the board to incentivize private sector mobilization. We're looking at all of this in the context of the European legislative framework currently and at the moment. Of course, we are right now, as you know very well, changing leadership. So at the moment, we have to wait and see for the hearings. I'm sure that all of you, like us, are waiting eagerly for the first week of November to see where we're headed. And I'm sure that many of these questions will actually be asked to our commissioners and executive vice president designate. I think, on the last points, it's clear that we do need frameworks for translating policies into action, including through investment plans. In my view, the NDCs are really setting the political ambition. They're not yet at the level of investment plans, and that's why we need to work in partnership. And we are already doing through various instruments, including guarantees and de-risking capital, foreign currency exchanges, for instance, to reduce the cost of capital for private sector. One thing that for me is really critical is that we shouldn't see the NDC ambition as conditional to international funding. I think the NDC ambition is first and foremost a domestic responsibilities that parties have taken on board, and you need to see that as an instrument to unlock and attract investment. So it's the direction of causality, if you wish, that from my perspective needs to change without a clear ambition that can then be translated with the help of the international community if needed into concrete investment projects. So there is, it's a sort of catch-22 situation. You will not get to the mobilization that you need to see.
Thank you very much.
Okay, very briefly, maybe picking up what Alessandra mentioned on the NDC. So obviously, we are hoping to see a higher level of ambition. I think the discussion today was a very good illustration that we really don't have the option, that we must have a higher ambition. But just to underscore the importance to have NDC that not only present ambition, but also very investable. And in a recent conversation we had with the UNFCCC, we have emphasized the need for this investable pipeline that we can fund, but also the importance for for the policymakers and the public sector entity that are preparing the NDCs to engage in a discussion with those who are likely to provide the financing, so that we can have a sense of, because otherwise it could end up also in a wishful thinking list of projects that nobody is willing to fund. So that's, of course, very important. My second, the response to the question. So obviously, we should use the entire toolkit. We should use the banks, we should use the capital markets for the green bonds, we should use the pension funds, and we should also use fiscal and monetary policy. Obviously, I think our moderator mentioned the subsidy reform. That's a very important piece in terms of fiscal option. And we have seen countries like Nigeria taking the bold move to do it. It's very painful socially. You need a lot of courage. I had the chance in my previous career to work on budget support operation. And I remember government officials say, okay, you know what? Let's talk about anything. Subsidy reforms, no. Reform of the education and public servant service, no. So so you need to, and that takes dialogue and takes time. So I see a role also for incentive through the central bank. They could be positive or negative, because you can say, look, if you do this thing, then you have to pay a cost, or an incentive. I'm more in favor of the positive incentive, because I have seen cases, for example, where banks decided to withdraw from some African countries, from Europe, just because it's too risky to do the business, and they didn't want to. And these are the dangers of the unintended consequence of something that is actually well intended, that you end up cutting some of the most underserved countries or segments into this kind of effort. Thank you.
Thank you very much, Soraya. So we've had a fantastically interesting debate. Thank you all for joining in, and also for those of you online. It just remains for me to thank our speakers.